let's take a look at the macro picture first, because we had, from a macro perspective, economic growth looking pretty strong at this stage, but the IMF highlighting that expansionary fiscal spending has increased the importance of actually rebuilding cushions and fiscal balances and international reserves as well moving forward. What's your view on the macro picture right now?
Well, thank you. Our GDP for the first quarter of 11, grew by 9%. I think this really been supported by the growth in industry areas and service and construction services area. We've seen a growth of about 17% and 13% in the services and construction sectors. But yes, we're looking at, by the end of quarter four 2010, I think government has spent about 85% of its budget. So this certainly has had an effect on the first quarter numbers. But again, interestingly, we've seen tremendous growth in terms of flow of credit into the private sector, registering about 38.3%, far exceeding the central bank's indication and projections for which were at about 20%. So overall, 9% growth, but still affected by food prices and growing inflation rate and exchange rate depreciation, indeed, according to the IMF report.
Of course, what are you making of those IMF comments where it said that the country needs to broaden its tax base by eliminating exemptions, where we've got revenues at 12.5% of GDP, and that low and insufficient to actually support things like infrastructure development moving forward?
Well, I think, the comments are indeed substantiated. We are looking at perhaps movement or some policy change as we come to the end of the fiscal year in June. I think we will see government try to address this. Indeed, the focus currently is the infrastructure sector. We do expect the country's focus for the next fiscal year to be on infrastructure, primarily focused on the oil support infrastructure, and also the roads and construction. So indeed, I think we will see some movement from government to address this come June.
Let's put the banking sector in the spotlight within that context, because we've had the cycle for banks posting their financial results for year-end December 2010 seeming to be positive. What's your view on the banking sector as a whole in Uganda right now?
Well, yes, very positive. We have had the Development Finance Company of Uganda posting a 20% growth, as well as Bank of Baroda also posting a 28.7% growth, which is very positive. This for both banks, we see a growth in their loan books and growth in deposits. Their treasury book has also increased by about 50%. We will see, I think, dividend payouts from these banks remain reasonably same levels as last year, although we have had a profit warning from Stanbic Bank of about 20 to 25% on their profit, but we believe there will be a slight reduction in the dividend and maybe a muted reaction to the warning.
Of course, Uganda boasts a high rate of private sector credit growth. Does that come with any concern from your end, where we may well see some loan loss provisions coming to the fore a little bit more aggressively down the line?
Well, I think so, but we have seen most of the banks now revise their prime lending rates up by about 2.5%. We will see how this will affect the credit, but yes, we do believe that there may be a slight slowdown between now and June.
In the meantime, looking at some other company news, Tullow Oil's paid $469 million in capital gains tax to Uganda. What next in the chapter to that story?
Well, Tullow Oil, I think, is moving to firm down its sale of those assets to Total and Sinopec, the Chinese oil company. Thereafter, we do expect there to be a cross-listing of Tullow Oil PLC on the Uganda Securities Exchange, perhaps by quarter 3.